There are lots of interesting themes being identified, starting from the tech spend and the dependence on the tech industry, where that capex is going to go, and that ultimately drives your winners and losers. On the market microstructure level, the behavior of the volatility is changing. The way the regimes are shifting is constantly evolving. We have the Fed put, and whether that it still exists or not going forward, with QT ending, and with other kind of macro themes unfolding, undoubtedly being influenced by geopolitics. The unemployment, the inflation, the consensus view seems to be that the inflation is going to abate, which seems hard to believe. Lots of perspectives where I think market may be mispricing some structural shifts and forces. So in your opinion, what is currently being mispriced, and what would make you doubt your belief? Igor, can we start with you?
I can't see any way out of this particular macroeconomic situation rather than through inflation. The Fed and other central banks in the developed world will have to print more money, infuse more liquidity in the market one way or another, and it will lead to inflation. The job market is one problem, and the persistent deficit is another problem, and there is no other way out rather than to inflate this debt. Nouriel Roubini was speaking yesterday morning here, and he said, all good, because with the advent of AI, we will have additional 2 percentage points to our GDP over the next 20 years. He is right, then all is good. But the problem is that no new technology added 2% to the GDP over the 20-year period. So it was quite a bold assumption. If I think about the past improvements in technology, then probably it's still going to be inflation. And therefore, I think that the bond markets are pricing a little bit too low inflation. I don't think that the equity markets are so wrong, because the more money is printed, the more they go up, and the more incredibly ridiculous the valuations become.
I mean, we're most indebted that we ever been as a modern human civilization, so it certainly adds to market fragility. From a macroeconomic perspective, Mark, what are your thoughts about where some of these mispricings are happening?
So I think part of it too is early in the year you had the sell USA concept, right? Whatever it's related to the US, equities, dollar, just sell it.
It was a good trade.
However, if you look at, say, like the foreign holdings of US debt, it's actually continued to move higher. That hasn't changed, right? So people aren't walking away from going long treasuries. However, the composition of who is owning it has changed a bit, right? China has always been known as being the largest foreign holder. Really, that peaked out around 2016, 2017. They're now in third place. Japan continuously kept buying US treasuries. They now are the largest holder of debt. Then you have UK, which is number 2. You have China, it's number 3. And China basically reduced their allocation by roughly about a third from about 2016. And then oddly enough, number 4, you have the Cayman Islands. And you kind of wonder, well, where is that coming? Is that offshore money? Where is that coming from if they're in the 4th place of that? But I would see that as being one of the things that is not changing, that the selling of America is not happening.
Judith, from your perspective on the microstructure level, what are you seeing there that may be not captured by the current consensus opinion?
For sure. So in the microstructure, low latency, high frequency space, we saw the market often underprice the persistency of regime changes and overestimating mean reversion. So our model shows that based on eGarch and econometrics models, the beta to persistence of regime shifts and stay there is a lot longer than usually when market priced in. And so unless we have evidence like aftershock, the level of liquidity just goes back to normal after a few sessions, or the realized volatility just goes down, decays quickly, we stay with our model beliefs that the volatility changes during regime shift is a lot longer than market expects.
The wrongful expectations of mean reversion have cost a lot of investors money over the last couple of years. You also mentioned the eGarch and just in general volatility detection. I think this is where AI can do a really good job.